Coming up on today's episode.
I might be a little bit biased in this answer,
Yeah,
obviously.
you're like, no, use the grants, shut up.
But I'm always of the impression, it's time in the market rather than time in the market. Like everybody's always saying there's going to be a housing crash, and it just never seems to eventuate,
Just let me know.
If you've got a crystal ball and you know when it's going to happen, you just let me know and I'll sell up beforehand.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together.
Hey guys, my name's Jacob. I'm from Alliance Financial Group. I'm on the No BS podcast today. We're talking about the 5 things you need to consider when you're looking at purchasing a house. Let's get into it.
Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, if you're a first-home buyer right now, you're probably asking yourself a lot of questions and you're probably hearing a lot of noise. There's the 5% deposit scheme, help to buy, first home buyer grants, stamp duty concessions, talk about prices moving, talk about rates. There's a whole heap of noise going on in the media right now. So today we're going to slow it down and make it simple. We're unpacking the 5 key decisions first home buyers need to make after the recent housing and budget announcements. Not just what you might be eligible for, but whether you should actually use it, when it helps and when it could hurt. And whether buying your first home to live in is always the smartest first step. So here to unpack it with me today is Jacob Williams from Alliance Financial Group. And with his background, you're going to understand why he's the best person to talk to and unpack this topic with. So Jacob, welcome to the show.
Thanks so much for having me, Jo. You give me a bit of a big head with that intro. But yeah, let's see if we can cut through some of the smoke and make it more accessible for buyers to get better information.
100%. Because I think, when I've had so much fun. We've caught up a fair bit and in such a short amount of time, and talking about the buyer space and all the noise that's happening, it is a lot of smoke and so hard for them to understand. Where does that lead me? Like basically the media is saying, don't buy, don't 100%. Buy, but here's all the grants to go and buy.
Exactly. I think whenever times get tough, there's always a negative spin in them. But with all these first-home buyer grants and schemes and everything, it makes it a lot more affordable for first-home buyers to get into the market. And I think, this market right now is probably one of the better markets for first-home buyers to get into. So, if it's something that people can afford and something that people are wanting to do, then why not?
Well, it's like, who is it? Warren Buffett, I think, said like buy when it's hard or like buy when it's the highest risk.
Yeah.
It's like, because you get the most reward. It's like people in COVID who were investing didn't know what would happen. And
yeah, exactly. And they came out the other side so much better off. So,
massive.
And we're seeing that sort of same market now. Not that, I'm a real estate agent or anything like that, but it's a good market to sort of buy into if you can afford to buy right now.
100%. And that's what we're going to go through today is, those top 5 things that you need to be aware of. So before we get any further though, Jacob, I think it's great for our listeners to know a little bit more about you. So for people that haven't come across you before, tell us a little bit about your background, how you got into this space. And just with the work you're doing with Alliance Financial Group.
Yeah, so my background has nothing to do with finance. I didn't come from a finance background. I didn't work for a bank. I haven't worked for other brokers. I sort of straight out of school, joined the military. Straight after that, did construction. Straight after that, joined the police force. And then, through investing myself, I sort of came to learn what a mortgage broker does and how they sort of operate. Liked what I saw, and then I sort of dove right in.
I love that your background's so varied. It's like a lot of brokers, they start with that banking background and it sets them up for a different pathway. But because you've come from I value a lot of people that do military or, services like FICPOL, because there's a massive, I've always wanted to do it and I'm too scared. so I stick to real estate.
Keep it safe, play it safe.
Play it safe, right? Sometimes not. So your time, military wise, what's that kind of taught you, or how do you kind of how does that show up with your clients now that you're in the broking space?
Yeah. So, obviously touched on the people skills, obviously a lot of people skills developed through time in, the police force, in the construction industry, in the military, but also that discipline piece. So, a lot of a lot of mortgage broking in itself is just systems. So if I'm disciplined, I follow the systems correctly, then we can get a good outcome, towards the end. So
100%. I think that discipline is a huge part of property purchasing, even just for the buyers, having that you got to stay on track. Like, what's the goal here? And I feel like that's where buyers blow out and sit on market for like 10 months just because there's so much happening personally in their lives. They're trying to buy, but they've got work or they've got kids, and the discipline is the hardest part. And having the right person, like a broker, your right professional being there to kind of go, it's cool, but we're back on track.
yeah. This is what we were planning to do. So let's stick to what we're planning to do. Yeah.
It's like, all right, just come back here for a minute. Let me help you out. And, do you think, I guess, like in terms of first home buyers, when they come to you today, what are they usually most confused about before they start this journey, or even, when they're talking about loans?
So what I sort of explain to people is there's three major things in any sort of lending scenario. So there's the credit, so making sure that you're paying your bills on time, all that sort of thing, so you've got good credit. The second part is the deposit. So a lot of people get sort of caught up on the deposit. How much money do I actually need? Some people think they need hundreds of thousands of dollars. Some people think they can buy a house with $1,000, so we've got to get that right. And then the third part is that servicing piece. So if all three parts line up, then we can get a loan, we can buy a house. And I think a lot of people get sort of caught up in that middle piece, that deposit. How much do I actually need to be able to purchase a property? And that's one of the big things that I sort of educate buyers on is, all right, this is the cost, because there's obviously the cost of purchasing the house, but then there's the closing costs on top of that. So, this is the deposit you need, whether it be 2%, 5%, 20%. And then this is the closing cost. So this is the total cost of buying the house. And I think that's what sort of trips a lot of people up.
I think so too, because there's that, if you've never purchased before, a lot of the advice usually starts with like your parents or maybe a friend or a family member that's done it, and sometimes that advice is 20 years old. They say, got to have a 20% deposit. And these days, a 20% deposit is huge for the median house price.
Oh, it's massive.
And it's like, from the broker perspective, you're like, it's not the only way to do it.
Yeah, exactly. And going back to all the, the first home buyer grants and schemes and stuff, it's not even the most feasible way to do it either, because saving that 20% deposit is going to take you so much more time. So it's going to take you a lot longer to get into the market, whereas you can get the same benefits with a 5% deposit now. So.
And I think that's the key thing, like to highlight, like before we move on to, what we're going to talk about today is, time in market makes a difference. So let's say you are spending that time to build up, you've got it in your head that you need a 20% deposit. While that's great and it, reduces that loan value ratio, through your borrowing, what happens is your house prices when you start saving today, let's say that they're at 800,000 in Melbourne. I'm just spitballing, right? 800,000. Now let's fast forward 3 years. It's taken you to save 20% for that 800,000. That property at 800,000 is now looking like $1 million. And you're like, oh shit. Now I'm buying a unit for the same budget that I could have bought a house for. Yeah. So it's all about understanding though what is available to you. When does it actually work though? So that's today's topic, and I'm excited to crack into it with you.
Let's get started.
Let's get started. Now, before we move any further, I have to put our no BS statement of the day on the floor for everyone. So if you're new around here, we always say a statement that's a little bit spicy, and then right at the end, we'll have Jacob determine whether it's bullshit or not. So we're not going to answer it, but I'll tell you today's statement. Today's one is the best first home buyer scheme is the one you don't actually need. So we're not going to answer that yet. We'll come back at the end after we've talked about everything and see if that's bullshit or not. So let's get into it. Today's topic is the 5 first home buyer decisions after the budget announcement was recently done. So decision 1, are you using a scheme or the scheme as a boost or because the whole deal depends on it, right? So there's a big difference between using the government scheme to make, a strong purchase in the market or make it easier, and then relying on a scheme because the whole purchase falls apart without it. It's like that's your only option of purchasing, so you rely on it. Jacob, with your first home buyer clients right now, are most of them using the government schemes, or are there still plenty buying without them?
Look, I would say out of the first home buyers that I do, so first home buyers is my predominant market, and out of that, more than 90% are using it. So it's, a lot of people are using the schemes because they're so low bar to entry.
So there's an option. So it's like accessible, they can use it.
100%. Yeah, because with a lot of the schemes, so like obviously we'll get into the schemes a little bit later on, but with a lot of the schemes, the eligibility criteria is so vast that most people in a position can use them. And if they benefit from using it, then why not? So.
Yeah. And that's the position I think like you as their broker is kind of assessing. It's like, is there ever a position where you would say someone should, like it's not going to be a good idea?
Not necessarily. I think the only time there's a position where it's sort of, not a good idea is when they're outside of that eligibility criteria. So, if it's the 5% deposit scheme and they have saved up that, 20% deposit, then they don't need the scheme. So, they can't use the scheme. So that's probably the only time that's sort of the 5% where they don't use it because they're not eligible for it.
Yeah. I think that's a key point you make, right? It's they don't use it because they don't need it, right? It's like pointless. They've got enough to kind of do it themselves. I'm just thinking, let's skip ahead and go through it. You got the 5% deposit scheme.
Yep.
You got Help to Buy.
Yep.
The first homeowner grant.
Yep.
And then you got the stamp duty concession option.
Yep.
So in simple terms, what are those, like, what do they all service and who's the best one for them?
Yeah, perfect. So, I mean, there's also the First Home Super Saver scheme.
Oh, of course, yeah.
But that's like, prior to purchasing. But we'll start on that one. So First Home Super Saver, you can contribute extra funds to your super and then you can take them back out at concessional rate. So, in simple terms, if you pay 30% tax, you can contribute 15 grand a year to your super and you pay 15% tax instead. You're saving 15% tax. It's just sort of a tax write-off, a way to save up a little bit quicker. So you sort of start with that. If you've got time, use that to save up.
So that's for like more like that pre-purchase stage.
Exactly.
So it's like if you don't know how you're going to save that deposit, this is a way to actually reduce the amount of tax that you're going to pay.
100%.
On that.
Yeah. I mean, you're still saving the money regardless. You're just paying less tax. So benefit to you.
Nice.
Right? So obviously not a tax agent, by the way.
Yeah. Well, don't worry, we got disclaimers, Jacob. It's cool.
But yeah, a good way to sort of save up. And then you've got the federal scheme. So the Help to Buy, there's some eligibility criteria with that, but the essence of it is the government will put in 30% and they'll share equity with you. So they will purchase 30% of the property. Sort of benefits of that is obviously you don't need to pay for that 30% up front. So that you do need to pay it at some stage, but you don't need to pay it up front. So it makes the loan a little bit cheaper, makes it more affordable for you to purchase. If you're looking to do construction, they'll go up to 40% on that scheme.
Damn.
So yeah, it helps you get into the market without having so much capital. The 5% deposit scheme, it's just a scheme to avoid lender's mortgage insurance. So instead of bank of mum and dad, where mum and dad put up a security and you go guarantor, the government's basically saying, we got you, we'll guarantee the loan. So you don't have to pay lender's mortgage insurance and you'll get better rates. The first home owner's grant is the $10,000 grant, only available if you're going to build.
Yeah.
I have had clients in the past get the grant because they bought something straight off a developer. So, somebody that's, knocked down a house and built 3 townhouses on a block. You buy one of those townhouses that's never been lived in, you're still eligible. So, $10,000 grant there if you're eligible. And then the stamp duty concession. So under 600K in Victoria, you don't pay any stamp duty. And between 600 and 750, you pay a reduced stamp duty. So there's a lot of grants and schemes that are eligible, that are available for people should you be eligible, right? So, the cheapest house that you can probably buy on the market at the moment is that 600K because then you avoid stamp duty. You don't have to pay lender's mortgage insurance. You only need a 5% deposit. A lot of things sort of going for you in that space.
And you can mix and match some of these schemes, right? Like if you're looking at you might have done the super saver right at the beginning, then you're coming in to purchase, let's say, like you said, the 10,000 if it's a new property never lived in. Are you also eligible for other ones at the same time?
Yeah. So on your first purchase, you're always eligible for the stamp duty concession. Should the obviously valuation fall between that, under 750K. You can also use the federal schemes. You can't use both the federal schemes in conjunction because they sort of cancel each other out, but
of course,
you can use one or the other. So you can use the 5% deposit scheme or you can use the Help to Buy scheme. And then you can just stack everything together and make the purchase more affordable to yourself.
See, that's huge. And I think a lot of people think they have to go out and do this sometimes either by themselves or they're going directly to their bank. And that's where I'm like, mortgage brokers are much more commonly used now as a first point of call. Like someone refers a broker and says, oh no, I use this broker, go chat to this bloke. And that's part of what we do on the podcast is have, people like yourself on to say, well, we vet them. So it's like we're talking about it, we're hearing from them. So what I like about the way you've kind of laid it all out is it seems simple in the sense that there's options available, it's explained easily, and a good broker can actually help you stack what's available to you.
Yeah, 100%. And one of the other things to sort of note is that not every lender is available for every scheme. So there are specific lenders that the federal government or Housing Australia has sort of selected or worked with to produce those schemes, right? So if you end up going straight to your bank and they're not part of that scheme, then you just don't have access to it.
Yeah, which is a big thing. So, and like this is the other point too. I guess when like this decision of using schemes, like I've had a lot of, you would get this a lot too. Let's say the first home buyer has a deposit of sorts and they're obviously with you to buy a house. And there's a decision to be made around, oh, should I buy an investment instead and Rentvest as a strategy, or should I buy something to live in, depending on where their deposit's at, right? Because you might have told them you can only buy $450,000 worth of property and they're like, that's not what I like.
Of course. Well, I had this conversation with a client literally this morning. They were saying, I gave them their options. I can't remember exactly the numbers, but it might have been a 600K purchase. We'll just say it's a 600K
Easy.
purchase. And they were saying, well, 600K isn't enough. So maybe I'll look at, Rentvesting and I'll buy an investment property instead of the first home. Issue with investment property, not so much issue, the fact with an investment property is that you won't get any of the schemes, the grants, anything. So, you're going to be liable for the stamp duty. If you've only got the 5% deposit, you pay an LMI, your rates are going to be higher. So what you can afford to purchase as a first home might be a lot greater than what you can afford to purchase as the first investment. But something to sort of weigh up and consider is, do I buy a house now, right? And then buy what I can afford, in an area that I can afford it, and then sit on that property for a little while, let that grow in value, and then move on and do something else in the future? Or do I rentvest, live where I want to live, and then invest in whatever I can afford? And what does that look like? Because if it's like I can buy a 600K house now, or I can buy an investment, but it's only going to be 300K. Like, well, what can you actually buy for that? So.
And that's the challenge. And where like your professionals, like if you have a buyer's advocate or, you need support, like there's option, that's where you would talk to those kind of professionals and say, help me out. What can I buy? What's realistic? Right. But you make a good point on the pros and cons of it, because that's, I feel like, a decision that a lot of buyers are in at the moment, is their deposit and what they can afford to purchase is not quite what they were hoping for. So it's like, I know I can do it. And if I keep waiting, I'm going to probably never get there. What can I buy right now? So do you ever think that there are circumstances for people like this bloke that you spoke to this morning, that client, do you think it would be better for him on his budget and his case to either keep waiting or, maybe not him specifically, but in general, to keep waiting or to make that reinvestment in decision?
I might be a little bit biased in this answer, obviously.
You're like, no, use the grants, shut up.
But I'm always of the impression, it's time in the market rather than time in the market. Like everybody's always saying there's going to be a housing crash. There's going to be a housing crash. And it just never seems to eventuate,
Just let me know.
If you've got a crystal ball and you know when it's going to happen, you just let me know and I'll sell up beforehand. But no, so you don't know what's really going to happen in the market. So it's better to sort of buy what you can afford now, hold on to it for as long as you can, because like if you're looking at it from an investment lens, property is one of those things where you've got to hold it for a long period of time. It's not a get rich quick scheme. It's not going to be something overnight, I'm a success, It's you're going to have to hold it for, 5, 10, 15 years before you see any sort of benefit from it. So yeah, I would sort of recommend in that sort of situation that you buy what you can afford and then you hold on to it for as long as you can. And then in the future, if it grows in equity and you decide, all right, now's the time to upgrade or downgrade, or, now I want to rentvest, you can sort of move out of it, use it as an investment property, or you can sell it, use the cash to buy other investments, So.
Yeah. And I think it leads perfectly into decision 2, which is exactly what I'm trying to weigh up, is do you buy that first house or do you rentvest, right? So with this part here, like I want to give you kind of a scenario-ish, right? So like they're trying, if a first home buyer's trying to buy their home, they want to live in it, but the numbers don't always work like exactly with what they want, right? And I think that's a common thing that we're talking about. The question becomes, do you stretch, wait, move further out, like buy in a different location? Because this is often, I find property as a mentality, right? There's a lot of pressure, in my opinion, around the word first home buyer. I don't like it. I call them starter buyers, starter home. Buy your starter home, right? Because it lowers the pressure. It's like first home sounds like that 4-bed, 2-bath, perfect for kids, got to have a pool, got to live here for 20 years. I'm like, just buy the starter home, just buy the thing. And sometimes I feel like we're hung up on location and we get a bit too fixated on where we want that property, how we want that property to look. You've got to know, it's like perfect. It's a utopia that might not exist. And that's what's screwing you up with time on the market versus timing the market. That's my view. So when I see first home buyers that can't afford like that home that they actually want, and then they want to live in it, how do you help them think through those options?
I think also how I sort of organize it with my buyers is I will upfront give them, the borrowing capacity and the purchase price and everything else. And I'll give them all those facts up front. And then I'll say, go on to realestate.com,
Have a
see
look.
what you can find. Yeah. If there's something you can find in that sort of price bracket that you're like, I could actually live there, then we sort of move on with the pre-approval and, then we get that scenario going. I think there's always going to be like lifestyle factors. There's going to be things that are unavoidable, right? So it's going to be how far out can you move, right? So if the purchase price is 600K and you're currently living in Hawthorne and it's like, all right, and you're working in Hawthorne or you're working in the city or wherever, how far out can I move that's affordable before it becomes like a killer for my lifestyle,
Mm.
Can I move out to Werribee and still work in the city? I mean, a lot of people do. So,
Yeah.
it's doable, but do you want to have that 30, 40-minute commute every morning? Or, do you want to save up a little bit more and buy something, in that area that you want to live? Yeah. And then weighing that up against what we were saying before with, time in the market, you could probably make a lot more money if you just bought something now and then sat on it for a couple of years and then sold it and upgraded it or whatever the case may be. So
Yeah. So it's those key, it's like compromise is how I would say it. It's like, what are you able to compromise on or what won't you compromise on? So if budget, but I actually like the way you give it to them, that you give them their numbers and say, go have a look. And if you can find something that you're happy with, like, let's play that out. Let's say I do come back and go, I'm not thrilled. Like it's a unit and I don't love it, but that seems to be all we can get unless we keep waiting for that right property to come on market. When is that strategy? Like, when do you start looking at different strategies with these buyers? If they're really motivated to get in, but they just like they think that now's the right time, how do you start to shift that strategy?
Well, in that same scenario, we can look at the two options, right? Because you've always got options, but we can look at the two options in investing or in a rock, right?
Yeah.
And then we can do the numbers on both and I can show them what investment would look like, what the purchase price is, everything like that. It's probably going to be a lot lower than own a rock, depending on their, situation and how much deposit they have. But as a general rule of thumb, it's probably going to be lower. So if they can find an investment and rent somewhere that they want to live, then great. We can sort of pivot and look to invest instead. But sort of 9 times out of 10, it's going to be, well, if I can only afford a unit as a owner rock, I'm probably not going to be able to afford much as an investment, right? So then it becomes, all right, like that compromise, like, all right, like let's deal it in a 5-year term, right? So can you live in this unit for 5 years? Is that a possibility? It's a starter home. So is a possibility 5 years, right? And then let's go on to, I use Your Investment Property Mag. It's got like the tracker of like
nice
suburbs.
I know exactly.
So I use that a lot. And so I'll put in the suburb and it will give me, the average yearly growth of a unit in that area. And then I'll say, all right, well, let's spitball the idea. So we're buying a 600K unit in this area. It's got an average growth of 5%, whatever the case may be. Every year you're going to make approximately this in capital growth. 5 years, let's hold on to the property and then let's, upsize in 5 years' time. Then you'll have a bigger deposit. You might be able to, hopefully in 5 years' time, your income's a lot more than it is currently. So let's look to buy the next home up from that
Yeah.
starter home at that point in time. Let's create a strategy where you get what you want. It might not be right now, but you get what you want eventually.
And sometimes, like, going back to the grants and those options, it's like, yes, you want to take advantage of the grants, but once you do the numbers and actually play out the scenario for the client, then they've got a clear way to make that decision to say, okay, even though there's grants and stuff we could use here, I think this is still probably the better way to go,
Exactly.
So
Yeah.
it makes sense. I like that it's personalized. I think that's what a lot of buyers need. So that's why I'm always saying, talk to a broker, they're free.
Exactly.
They're paid by the bank. So just have a conversation and find out like those options, because once you see it laid out, like I'm going through this with our producer sitting next to me. He's currently, him and his brother are trying to invest at the moment, and they're going through their finances, and I've been helping them out like with understanding what they can and can't do. And it's been interesting to watch them go through it, because they're like, oh shit, is that how that works? Oh, okay.
Yeah.
Interesting.
I didn't realize that was a fee.
Yeah, it's like, oh, okay. Oh, I have
cost there.
Do I have to pay stamp duty? Yes. So there's a few reality checks along the way that suck. But it's good. It's good learning. They're young blokes, they're early 20s. So it's good that they're getting in when they are. And I'd encourage anyone to do the same. But it brings that decision of, do they want to go and spend all that money with all those fees and not take advantage of the grants as their first property, because they're not going to live in it.
Well, I think in Victoria, like especially, there are like opportunities to use the grants and schemes in the future.
Well, that was my next question. Can you?
Yeah. So a lot of other states, as if you've owned a property, that's it. You're ineligible for everything.
Yeah.
Victoria, we're a little bit blessed where you can own investment properties and still get the first home buyer grants and schemes. Federal schemes are a little bit different. Depending on the scenario, you might be able to buy them, but a lot of the federal schemes, they want you to only own that owner-occupied property. So you can't have investments in property elsewhere. So
that's actually really good to know. Like, I think that's not commonly known. I think there's still the misconception in Victoria specifically is like the federal grants. Like if you've used it, or if you've foregone it, you've lost it.
Yeah, exactly. Yeah. So there may be an opportunity where people can use the grants in the future. Who knows if that will always be a thing. But at this point in time, there is an opportunity that you can rentvest and you can still use the grants in the future for yourself. So
perfect. Oh, well, actually, that answers like that second decision. It's like you just need to know what your options are, even though subject to governments will change. They will do budget announcements, and we never know when that's going to happen. Depends on what they're thinking and what they're trying to fix in our economy. But be aware of that side of things. But as soon as something gets announced, I always say call the broker, like call whoever your broker is, and just say, hey, does this affect me or not? And it's like, yes, because we bought you. They're taking away that opportunity, so you can't now go and use the grant like we planned. So yes, this will affect you. What do you want to do?
Yeah. Well, that was a conversation that I had to have with a lot of people during the budget announcement, when they sort of took away negative gearing on all existing property. Oh, obviously it hasn't passed legislation and everything else, but all the banks have already started putting that into their policy. So, anything past the 12th of June that you purchase, no longer can you use negative gearing in terms of servicing. So it makes subsequent purchases a lot harder, because servicing's that third critical piece if we go back to the three. So,
all right.
Yeah. So I had to have that conversation with a lot of investors to be like, hey, we were planning on using negative gearing. No longer are we able to. So purchase prices drop significantly.
Yeah. This is a big thing, right? And this is why we're here. And this brings me to decision 3, right? On today's 5 things. Are you looking at the purchase price or the cost after settlement? I feel like this is a big thing that people overlook, right? In terms of getting into the property is one thing, living in it and managing it is a totally different one again, right? So there is this is where the first home buyers, I think, technically are approved. It's like, go ahead. You got 700, 800,000, go spend it. You can do it. But then there's a lot of excitement that happens where they buy the property, and then they kind of don't think about the aftermath of that property and how that actually how is it to live with, and all the scenarios of what happens if you lose your job, what happens if this happens. And I know it's morbid to think about because you're trying to be excited, but
100%.
Are they part of the conversations that sometimes you do have to have?
Yeah, of course. You always have to have the conversation of this is what the cost is going to be. Is that manageable for you? Because life changes all the time. I actually talked to an old broker a couple months ago, And he used to, with his, purchases, he used to say, take the cost of whatever the cost is going to be per month. So if it's going to be 4K a month that you need to pay in terms of the mortgage, take 4K a month, put that away in a bank account, don't touch it. And then do that for 3 months and see how your lifestyle changes. If your lifestyle doesn't change and you can afford to put away the 4K, let's buy the house, But
Yeah.
if you're putting away that 4K and all of a sudden, you've got to drop off the sports, you can't go to the movies anymore, you can't go out for dinner, it changes your lifestyle dramatically. And it's things that you can't compromise, going back to the compromise again.
Yeah.
Then don't do it, right? Like it's all about personal preference, what you can afford to do. Because obviously when I do all the calculations and things through the lender, there's going to be an assessment buffer. So the lender puts on a 3% buffer to what you can afford. So for argument's sake, if you can get a 6% loan, they'll make you afford it at 9%. If you can afford it at 9%, then they'll give you the loan. So there's always going to be a buffer and like affordability. Yep. But that being said, if the 6% rate is going to be hard for you to manage today, then, if one thing was to change in the future, it might be impossible for you to hold on to that loan. So it's not really worth you doing if it's going to affect your lifestyle that badly.
I think this is where a lot of people in COVID got caught out. It was because rates back then were like 2.5, 2.6%. And they were, serviced, like you said, higher. So they were like being calculated at highest risk being possibly 6%, right?
At the max.
The max. We're floating.
Past that.
We're floating by skin of the teeth for a lot of these COVID purchases. The benefit we have, though, is it's been 6 years. So if they can't service that loan anymore, or they haven't had a pay rise in their job, or things haven't changed, or that's gone the opposite way where they've lost jobs and stuff like that, now's the time where you could consider, okay, well, do we move the property on? And use the equity and either downsize or upsize or buy something else.
Yeah, exactly. Yeah. And the benefit being is that, during COVID, the prices were a bit wacky. So they might have done really well in the last 6 years where they could probably downsize and have a much smaller, more manageable sort of mortgage and still enjoy the same sort of lifestyle. So
I think that's a critical tip you mentioned, though, from that old broker. You said, my parents made me do that. That's how I saved my first deposit. I had to pay them a mortgage.
You had to pay off their mortgage.
Yeah, I had to pay off their mortgage, and they saved my money for me, but I wasn't allowed to see it. So it didn't sit in my savings account, right? So it sat in whatever saving account they had set up for me. But they said, you're paying a mortgage. So I had a full-time job at the time, this is real estate agent. And they said, yeah, you're going to give us mortgage equivalent. And I'm like, why would I do that? I was so frustrated by it.
Now I can't go to the movies.
Yeah, I can't do anything. I said, I'm living like I'm poor. And they're like, no, you're allowed to cash it out for certain things. So when I had enough money, I traveled they said, yeah, if you want to access it, go travel, and I'm like, okay. So I went and traveled, went to Bali with my mates, and that was a lot of fun. And then even at 22, after I was 21, at 22, I came back and then they said, hey, you can buy a property if you want. And I'm like, what do you mean? I have money.
I'm like, how much money do I have?
Yeah, how much do I have? And
interest? Were you earning interest?
Yeah, so, how much have I earned?
They were just skimming off the top.
Correct. Yeah, it's like I'm just they screwed me. No. But it was a really good practice for me, because then when I did get a mortgage for that first investment, and I bought land, right? I just bought cheap land. That was my first purchase, and I made a whole heap off of that land, and that helped me. Well, because it's I think about it from mechanics, and this is why I like talking about the finance side, especially with first home buyers, is because that first purchase I made at 22, 23 wasn't anything to write home about. It was just I didn't know what I wanted to do with it. It was do we build on it or do I not build on it? Do we leave it? So I left it. I didn't even build it. I just did nothing with it. I just paid a $25 a month water bill for 3 years, 4 years. And that's literally all that happened. And because I was undecided, I was like, oh, do I want to save up and keep building it? Or do I want to put tenants in it? I just had no idea what I wanted at the time. And I was in real estate, so I was so undecided with where it was going to go. But then I got a partner, and then it was, hey, we should buy a house. And I'm like, cool. I'll sell that land unless you want to build on it. And the land was so shit. It was such a small, it was so shit. I say shit lightly. The size of the land and the block, it had a 7.5 metre frontage. So for anyone that doesn't know, average is maybe 12, anything above 9, I would say is okay. 7.5 metres is the frontage. And
townhouse. Yeah.
And there was the length, like 38 meters. So
Skinny and long.
Skinny and long. And when I showed my partner and I found a property that had like a similar block size, I remember she said, please don't make me build a house on that. Please don't.
What are we gonna
I'm
build
so
on that?
depressed. She goes, well, we're just going to have one length and one room on either side. And I'm like, yeah, fair enough. So we sold it, but I made a lot of money from it, and that funded my deposit. So my deposit, really, I only had to front up like less than 10 grand. And that got me to move in the market.
Yeah. Well, and it goes back to timing the market, you know.
Yeah.
So you didn't have to time the market. You're already in the market.
Correct.
Albeit like a block of land, but you were in the market for that period of time. So then you made money on your investment, you could sell it, and then you could use that money to do other things.
That's right. And that's why I'm always saying, like, what are those options? Like, is that rentvesting the right thing? Is it not? Is it moving in and buying that whiz bang beautiful first home? Or is it just, you know, holding off or buying that starter home, you know, to say, I'll live in a unit for a couple of years. It's a little bit further out than what I'd like, but I'll suffer with it not suffer, but like I'll enjoy it. I'll struggle through some of the challenges with it for a couple of years. I'll wait for the equity to build and then I'll get rid of it. Yeah. And that's a viable option either way, in my opinion. But I love that the grants are an option down the track too.
Yeah.
And I always go off track, you know me. My poor audience are like, yeah, what's the next one?
What are we up to? Number 3?
We are up to number 3. And I think, you know, one of the things I want to talk about is the buffers. Like you mentioned this very lightly, is when the rates are higher and the cost of living goes up, this is where, you know, those buffers kick in when you're managing a property that you've already purchased. So I'm at the point now where we're talking post-purchase. You're managing it. How do you know, you've already calculated that the bank will add that 3%, right, yep, to your buffer. But how does that factor in for cost of living and like how the broker kind of helps you know things that are unknown that could happen? How do you build the right buffer?
Yeah, I think you build in a buffer 2 ways, right? So you don't want to be at the max serviceability. That's, yep, you know, buffer number 1. Obviously, the lender's already put in that 3% buffer, but at the same time, you know, they'll have, after we do the calculation, it'll be like, all right, post loan, you'll have a surplus of X amount, right? So you want that surplus to be healthy, right? Yeah. You don't want to be completely max. I mean, some people do go to the complete max, but it's probably not advisable, right? So you want to have a healthy buffer there. Then you've already got that 3% buffer. And then on top of that, you want savings, right? Like going back to maybe like the barefoot investor and talking about the buckets and everything. You want that, you know, 3 to 6 months worth of buffer held as savings after the loan is complete. And a lot of those, the 5% deposit scheme, their requirement is that you put in all of your savings bar a buffer, right? So you can keep a buffer with those savings. And I think at the moment, a lot of lenders will let you go up to that 30K mark.
Yeah.
So they'll let you retain 30K after all said and done. So if that buffer plus, you know, you've got a little bit of a servicing buffer, you should be right to weather the storm. And then like any sort of lending is a snapshot in time, right? So you can't obviously predict the future, but we're talking about right now, this is a snapshot. You've got a little bit of a servicing buffer, you've got your cash buffer, but then on top of that, hopefully in the next couple of years, you get the pay rises and everything else, and that puts a little bit more of a buffer on it. So, you know, obviously nobody can predict the future, but as long as you have enough buffers where you feel safe and protected, then it's time to purchase, right? So,
yeah. And that's part of the work they do with you anyway as well, is to figure that out. It's like, okay, so if things went bad, what buffers have we got in place to help you weather the storm?
Exactly.
And I think that, you know, too, like bringing it to decision 4, right? Now we're on track.
Back on track.
And we've touched on it a little bit, but it's like, are you waiting for the right time or are you just waiting? And I think this is a big thing of, again, timing the market versus time in the market, right? So a lot of first-time buyers will sit on the sidelines and get a bit scared of, well, when they've been pre-approved, this is where they get the most excited, but then also the most disheartened probably a month later, because you start to make some offers. And some of you listening, I sympathize with you guys. It is tough because there's so many emotions to buying. When you finally get that pre-approval, you're elated.
Oh, that's the best time.
It's the best. It's like the excitement is like at its all-time high. It's like, oh, okay, we can do it. And then you start looking at realestate.com, you go to some inspections, and then you find that property that you want to make an offer on or go to an auction for. And that's where, you know, you might, if you know, luck wasn't on your side or, you know, the offer wasn't at the right price, you start to miss out on properties and it starts to really deflate you. And you start to go, maybe it's not the right time to buy. Maybe we won't buy. maybe we'll take a break from the market. And then all of a sudden this pre-approval that came in has turned into 6 months later, you still haven't purchased.
Yeah. Well, yeah, exactly. So I feel like, yeah, you're perfectly right in saying that, yeah, that when they get pre-approval, that's they're happiest, right? And then 3 weeks later, after they've gone to 3 separate auctions and all of the auctions have quoted 600K and that's their purchase price, and they're like, this one's mine. And then it goes for 700
Yeah.
and,
Underquoting.
they turn around and they go, what was that?
Yeah.
But I feel like, and free plug for a Bodie. This is where a Bodie comes into it, right?
Appreciate it.
So with like, when they're actually looking at property and they can, get a property report for the property and, agents quoted 600K, but then price guide is actually 650, 700. They can sort of turn around and go, all right, well, we might go to this auction, right? Just to see what happens. Cause it's always good. You never know. But their sort of realistic expectation is that, it's going to go for 700, right? So they get there and they're not disheartened when it does go for 700 and they go, oh, yeah.
I expected this. No, appreciate the plug, because that's why we give you the, like in the mobile app, and like our listeners know that we do have one, but in the mobile app, we give you the average valuation so you can kind of see if the underquoting has happened. So if they're saying, oh yeah, the auction will go at 700K and you can see the valuation came in at like 750 to 780, you're like, oh. And it's like, that's where it is. Okay.
Yeah. That's where the market is.
That's the market. That's where someone will buy it. That's where someone with a buyer's advocate has already advised them, don't worry about the asking price. It is going to go for 780 and they're prepared.
Yeah.
And this is what we want to avoid, is you getting disheartened through the journey, just realistic expectations.
Yeah. Yeah. I think, if you set the realistic expectations at the start, then you're not going to be sort of disheartened during that process. So.
And when you get those buyers that come to you like that after those few blows that they've had, like after, let's say, that first month, what's your kind of advice to them at that point where they're kind of feeling like, oh, should we wait? Should we wait a bit longer?
Yeah. I mean, we sort of set up the strategy from the start and, this is what you can afford to buy. So look around this sort of price range. And so when they sort of get to that, I go, all right, well, we need to sort of set realistic price range, right? Then, so we're looking at, 6 to 650, but we're pre-approved for 600. Maybe we need to drop the expectation down to that 5 to 550.
Yeah.
Find something that you can actually afford to purchase and then get into the market. If there's the compromise, right? Like if you can look at 550 and you can go, all right, there's actually a few properties here that I like and I can compromise. It's maybe just a little bit out from where I want to live, but it's not too far. It's 3 bedrooms instead of 4 or whatever the case may be. If you can compromise, then let's compromise and let's buy. If you can't compromise and you look at it and you go, absolutely not.
Hell no.
Yeah. Then unfortunately it's not the right time to buy, right? So we either need to go back to the drawing board, see if there's other government grants and schemes that we can use to get you up to that purchase price, or, set a realistic goal for like a savings expectation, or, go away and go, all right, this is what you need to be on income wise to achieve what you need to achieve. And let's just wait,
Yeah. So it's like you're preparing them. It's like to say, okay, if you're not happy, this is what you need to do between now and the next 6 months,
exactly.
to try. And it's like, oh, okay, cool. So it's always about getting that next step. I find next step guidance is huge, because you just get lost.
If we go all the way back to the start, that's where that discipline comes in, right? So we stay on track. It's a process. So we build the process from the start, and then, if the process leads to a house, great, the process has worked. But if it doesn't, all right, how do we get to that next step? How do we get to the house?
So how do we pivot and make sure that you do get there?
Exactly.
Yeah. So, and I think when you talk to a lot of property professionals, we're always on the optimistic side, because we see people do it all the time, or we've done it ourselves, and we're like, we know what you're going through. It's kind of like when you're a teenager and your parents say, you'll get over that fight with your mates. You won't even care about it in 10 years. And at the time you're like, no, I will.
Like, this is everything to me.
It's like, it's the worst it is at the moment, because it's the first time you're doing it. So it feels like it's devastating. And it is in a lot of ways. I sympathize, but it's not the be all and end all. It's like there's so many doors in.
100%. And who knows what the government's going to put out for first-home buyers in the future. It might become a lot easier to purchase. You don't know. So there's always going to be avenues to purchasing if purchasing is the goal. But it's not the goal for everyone. You know? So, if it's not the goal, then
don't stress.
Don't stress.
Just rent. You'll be right. So, or if you've got parents that really like living with you, you're good.
They got a bungalow out the back. You're fine.
You're fine. You got your batch pad. We're good. And this brings us to decision 5, which is the final one today. But we've got a Reddit Real Talk segment coming up after that, which is we're going to put it all into reality. So decision 5 is who should be in your corner before you start making offers. And I think this is a big one, right? Because this is where we've talked about, we've kind of come full circle, what you do before, what you do during, what is available to you, how do you make those choices? But this final one is like, okay, you're going to make an offer. This is where that disheartened portion of you comes in. In your opinion, Jacob, like who are the right people to have it by their side when they're about to make these offers?
Yeah, so you definitely need a team, right? So obviously I'd like you to start with a mortgage broker.
Absolutely.
Not necessary, but definitely, beneficial to you. So you may as well. I think pre that as well, depending on your situation, maybe an accountant, for that first home super saver, or if you're, self-employed, how do I, make my finances look good? That's probably, the first step. And then, a mortgage broker to help you with the loan processing. What can I afford? What's realistic? All that sort of stuff. And then, so during the buyer journey, maybe a buyer's agent, if you can afford it, a Bodie if you can't.
Yep, there you go, plug. I swear I didn't have Jacob come here to plug a Bodie, but I'm loving it.
And then when you're actually looking to purchase, you need a conveyancer or a solicitor. So that's very important. I always tell my clients never sign a contract without having somebody look over it. And then, post-settlement, probably a financial planner. You also probably want to look at insurance as well because you've just made a massive purchase. You've got a huge loan. You want to make sure you're protected. So you want to look at life insurance, home insurance, all that sort of stuff. So, at that sort of post-settlement, you're sort of looking insurance broker and financial advisor.
Yeah, 100%. So. I love a dream team because it's true. It's true. It's like then you've got everyone working for you. And what a cool thing about it is too, is that the professionals do communicate together. Like oftentimes, like the broker will communicate with the conveyancer if they need to, or, if you can't afford a buyer's advocate, or the Abodi team will do the same thing. We work together because we need to help you get there. So you've got support.
Of course. Yeah. Everybody's on your side. Everybody's going to be giving you advice that benefits you. Right.
Correct.
So everybody's pushing you towards where you want to go.
Yeah. And I think each person has their role to play. Like I always bang on about, I've got my uncle at the moment who's looking to purchase a property, and I said to him, conveyancing, I said the Section 32 review, you might have to pay for it, but just before you start making offers, just make sure that everything's ticked off. And one of the things I said, I'll just do that as a subject to, the conveyancer review. And I said, okay, cool. So it's fine if you want to do it that way. The clause has to be airtight with what that means, because subject to review could mean that the house is a heap of shit, but that subject to review, you got it reviewed. You've fulfilled that contract need.
It's a bad contract, but it's reviewed.
It's reviewed, right? And I said that doesn't protect you at all. It just tells you that you want a conveyancer to look at it. Now, regardless whether the conveyancer says, hey, this is a heap of shit, I'd be careful, or they say it's a great opportunity, you're buying it. Like, unless you did that within the cooling off period, you're buying the property. So I always say, that is a huge thing for me, is just have it reviewed by someone who is going to tell you what to be aware of, because they also give you the clauses too.
Exactly.
They don't just give you, oh yeah, it's good, you can buy it. It's also, contracts have weird shit in them all the time. I had one contract when I was an advocate, and I remember going, oh, hell no, we're not doing that. So there was you had to pay when you make an offer, you got to pay a small deposit. Usually it's I think I'm going from memory here. It's 0.2% or, $200, whatever's greater. And you put in that couple of hundred deposit. Now that's fine. Depending on whether it's accepted or not, you can lose that deposit or it gets contributed. Now, losing the deposit is depending on how much time you waste and stuff around. There's a vendor clause in your contracts that sometimes have a box tick that says they can keep it, and you just lose it. And if you put in a heftier chunk, because the agent sometimes will encourage you, like when I was a real estate agent, say, can you put your offer's low, but can you put a more serious deposit down today, $5,000? And just to show your intent is serious, and that $5,000 will contribute to, the settlement cost. And some buyers were like, yeah, all right. But I would have to tell them in our contracts, but just so you're aware that
You lose it.
if you cool off and you take us off market for more, and back then cooling off period was 14 days, right? In 2010 era, it was shocking. 14 days to cool off. If you wasted 2 weeks of that property being on market, we could keep it.
Wow.
Yeah. So it's things like that a conveyancer highlights and says, that's weird. Don't do that.
Yeah, we advise
them
not to do that.
Yeah, it's like tell them to remove that condition.
Yeah, well, that's the other thing. They'll tell you what conditions to keep and what conditions to cross out before you sign that contract. So then you're protected.
And that's the whole thing. You're buying $500,000 investment. A contract review, I think tops will cost you maybe $400, $250 in some cases. Just get it reviewed.
Yeah, you might even find some that do it for free. You know?
Some of them do. Some conveyancers do 3 free reviews or 1 free review on a property, and you might not have to pay for the review at all. You just pay for their costs at the end.
Yeah, exactly.
So, dream team.
Dream team.
Dream team.
Get the team together. Get the team together.
And I guess that's why I say, like, you don't buy property blind. You just have to have a conversation, and why I use this podcast as that platform, because if you're too scared to make those phone calls, I get it. It's intimidating, but listen to an episode, see how comfortable you feel. It costs nothing to pick up the phone and say, hey, I'm thinking about buying. What do you do for me if I work with you? Yep. That's all you're trying to find out at those stages when you're purchasing. It's like, what do you do for me? Oh, okay. Well, I help you with loans. Cool. That's a broker. It's like, if you like them, go with them.
Yeah, exactly.
It's just, testing the waters.
Yeah. And then finding your own dream team, finding people that you're comfortable working with, that you think have your best interests at heart, and then, using them for their services.
I think finding people you're comfortable with is a big point. It's, if you don't feel comfortable, you're allowed to change as well. You're not locked in. If you're listening to this episode and you're like, I don't feel comfortable with my broker, he hasn't said any of this or she hasn't said any of this, that's okay. You can change over, and there is a process behind that, isn't there?
Yeah. Well, I mean, so you can change at any time. So even if you've pre-approved, with pre-approvals, it's just an approval in principle from the lender, right? So it's nothing set in concrete. You can still change lenders at that point in time. Your new lender will just say, what happened with the old lender? And all you have to say is, I didn't proceed with that loan. And you can get another pre-approval. Like, you can, obviously I wouldn't recommend it, because it goes back to that first thing, the one of the 3, the credit. If you do too many credit applications, then it's going to look bad on your credit, and then your credit score will probably take a hit because of it. But in saying that, if you're not comfortable with the bank, or you're not comfortable with the broker, or whatever the case may be, you can always switch. You're never locked in until you've actually got the mortgage. Right? Yes. And even then you can refinance. So you're never locked in, right?
No.
It all comes back to, obviously, refinancing, there's costs and everything else, but it all comes back to, you've got to be comfortable with everything.
100%. And I think this is the perfect time to bring this into the real world scenario, which is our Reddit Real Talk segment.
Let's go for it.
All right. So today's one, for those that are new around here, as we always do on this show, you guys submit stories to us daily and weekly, and we love it, because I get to read through them and go, oh, this will be a good one for Jacob, or this will be a good one for this person. So today's one I thought was really topical. So shout out to the listener that sent this in. I'll keep you anonymous. But here's the story we're reading out today. So it says, the inner West home buyer who doesn't know whether to buy now or wait. And they've written, my wife is very keen to move closer to the city. We're currently living rent-free and mortgage-free in a house that my family owns, but it's about an hour commute into Melbourne CBD, drive and train. If we pull together all our savings, we'll comfortably have $100,000 to $120,000 for a deposit and still have an emergency fund. She's looking at the Altona or West Footscray sort of area, the inner West, so to speak. Is it a good time to buy now with the rates being what they are? Currently, joint income is $150,000 before tax, but I'm looking for a new job as my current job with my family might fall through. We have no kids, just a cavoodle, no credit card debt. Cars are under the family business. One's paid off, another still financed, should be paid off soon. What are some of the things we should consider? So there's a whole heap there. But Jacob, if this buyer came to you with $100,000 to $120,000 deposit, saved, $150,000 joint income, pressure to move closer to the city, but there's that job uncertainty in the background. How do you unpack whether they should buy now, wait, Rentvest, or rethink the strategy altogether?
Well, obviously certainty is a big thing. So, if there's job insecurity, you sort of want to cross that bridge first. So, do you have a job lined up? Is it easy to get a job in your field?
Industry.
Because it might be, I could just move into a job tomorrow and that's cool, whatever, it's
Yeah.
fine. But if it's like, there's very minimal jobs in my industry, that's why I was working for the family business, because they're one of 2 employers in the whole country,
Yeah.
it's a bit more, you've got to put a bit of weight behind that. But, so say job security's tick, I can get a job tomorrow if I wanted to, or if I have to, or whatever the case may be. That's great. And then we move on to the 3 things, right? So we always go back to the 3 things. So we go credit, right? So obviously they outline that they've got no outstanding debt. They've got some
Business car loan.
Whether or not that's in the business name and can be sort of left to the business, or whether we've got to include that in their personal name. But if we'll say it's paid off very soon. So we'll just discard that. So credit, right? So they've been making their bills on time. They've, had a credit card in the past and always made payments on time, whatever the case may be. Their credit's good, right? We'll just assume, because obviously I don't know them. So
Of course.
credit's all good. Second thing we go on to is that deposit. So was it 100, 120?
100, 120, yep.
So 100, 120, if we're looking in a West, right, we're probably, depending on what they're looking for, if they're looking for a house, it's going to be, 1.5, 2 mil. Like they're probably not looking for a house, but let's say townhouse. I'm always on the market in that area because I live in Yarraville.
Well, this is why this was perfect. That's why I was like, West, let's go.
So, 800K can get you a really nice townhouse. It might even be able to get you a house that needs a bit of work, right? So 800K is probably sort of what they're looking to purchase for. If you go closing costs, back to the closing costs, you've probably got, you got your conveyance fees, your mortgage fees, your state government charges, stamp duty. We're outside of that 750K sort of bracket. So you're going to be full stamp duty, which is like 5%. So we're looking at like sort of 40K, we'll say 10K in other costs. You're well within the limits of the guarantee scheme. So you won't have to pay lender's mortgage insurance. So let's say closing costs as a whole is going to be 50K, right? 800K, 5% of that's 40K. So we're at 90K total required funds as a deposit, right? As a minimum deposit, but they've got 100 to 120. So
they've got their buffer.
So they've got their buffer. Yeah. If they don't have other funds on top of that, they've got their buffer. If we look at then using that, we're using that 40K as the down payment. So we're borrowing 760, right? Around about that. Then we look at the third thing is serviceability, right? So I think that 150K combined. So what I say, if there's no other debts or anything else, it's always about ×5 of your income is serviceability, right? So obviously we'll use proper lender calculators and everything else when we go through it like properly.
Yeah, we're not winging it like this. Yeah.
It doesn't just get winged, but there is a process behind it. But just as an example, so 150 ×5, we're looking at about 750 as a borrowing capacity. 760 was what we needed. So, put in an extra 10K and we get it down to that sort of 750. So that 800K purchase is probably achievable for this couple. In terms of serviceability, they're obviously going to be like on that higher end. So it goes back to that job certainty. Like we need to know that the job is good, because if they're going to be sort of maxed out at their servicing cap, then they're not going to have too much in terms of buffer per month. So we want to make sure that like job security is paramount.
Actually happening.
And then we want to probably look at insurance as well to make sure insurance is paramount. So then if they do lose their job or, they get injured at work or whatever, then the loan's covered, right? So it's always about risk management. So we want to make sure that the risk is all good. But on top of that, they've obviously got that spare cash. So let's say risk is ticked off. Then it becomes, all right, well, have a look on realestate.com. What can you find for 800?
Yeah.
And is it something that you would actually live in, right? Because you're going to be living in it for the next 5 to 10 years as a minimum, right?
Yeah.
Because if you sell it before then, you're probably not going to make too much money, probably going to get eaten up by cost. You want to sort of hold investment longer term. So can you live in any of those properties 5 to 10 years? Yes or no? And then if it's no, then what do we look at? Like, do we look at Rentvesting? How much can you afford to purchase as an investment property over the owner occ? And then we have those conversations, so we go through it all.
I think that is so well organised the way you mentioned all of that. Like probably one of the best answers we've had for this Reddit segment, to be honest.
Well,
no, honestly, just because it was methodical. So I think you've addressed that really well because, yeah, there's a lot of options there for them, but it sounds like the job certainty is probably the biggest uncertainty for them right now.
exactly. And it's all about risk mitigation, right? So you're making this massive purchase. You want to make sure you can afford the massive purchase. You don't want to be 6 months down the track and you turn around and you go, actually, I did lose my job and I'm one of 2 employers and the other employer doesn't want me. So
That's a really bad position, guys.
Yeah, and you're just kind of like, all right, cool. So where do I get money from? And then like we're going to this Friday, we're going to be in jail. You start selling drugs or something. And and then you end up in jail. So we don't want to go down that rabbit hole.
No,
I
have to give context. We are being locked up for charity, not for crime.
It's definitely crime.
Jacob's going to undo our reputations in 10 seconds. No, we're doing something called the bailout. We are trying to raise funds to bail us out of jail, and I'm on $20 and I'm not looking good.
I started doing Facebook posts and everybody just started donating. So I don't know if you've tried the Facebook yet, but put it off on Facebook and let everybody donate.
All right, good tip. I'll try it today. Watch everyone go, I'll pay if it keeps you in.
Yeah. Well, that's the joke that everybody was telling
Correct.
me. Yeah.
They're all going to keep
How much does it cost to keep you in?
Yeah, it's like, $10,000. It's cheap. No, but yeah, that's what we're doing. We're not crime. Jacob, stop telling everyone we are doing crime. He's already said, what contraband can we bring? Well answered, well executed on that answer. Thank you so much to our listener for submitting that one. I hope that actually helps your situation. But as I always say, just reach out and have a chat to Jacob if you haven't already got something in motion. Like conversation costs nothing to have. So just, pick up the phone. And in Jacob's case, like his service is free. So
exactly.
I always say that.
Can't lose.
You can't lose. Only lose when you pick the wrong person. So I can't believe how quick the time's gone, to be honest, because we're already at the end of our episode and I've just enjoyed the conversation. Thank you so much for being here, Jacob.
Oh, it's been so much fun. I have enjoyed it. I hope I can come back someday.
100%. No, that's no question. I was already thinking that the cogs were moving in my head going, the next episode we should do. So you will see Jacob again. And I can't let you go that easy without addressing our no BS statement of the day. I need your verdict. So as a reminder at the start of the episode, we said the best first home buyer scheme is the one you don't actually need. So final verdict, Jacob, do you reckon that's bullshit or not bullshit?
Oh, look, I don't want to give a long-winded answer.
No, go for it.
But I would say bullshit. I would say bullshit, right?
Love it.
Because I think that a lot of the grants and schemes that are available at the moment are so low bar to entry that if you can use them, it's worth using, right? Because you just save money. Like who doesn't want to save money, right? But at the same time, if you're ineligible for them, then that's great as well, because it means that you've passed all the buffers that are set out by the government and then you can afford to purchase regardless. So
yeah, it's a win-win.
Yeah, it's a win-win. But yeah, I would say as a whole, the statement's bullshit because I advise my clients to use as many buffers and as many grants and schemes as they possibly can because it just makes the purchase more affordable to them.
Yep. Well answered and wasn't too long-winded. I love it. All right, we're calling bullshit. Yes. No, I love it. And I love doing those statements because it's like neither here nor there. So it's like, yes and no, yes. So no, thank you so much, Jacob, for contributing today and for being here once again.
No, I appreciate it. Thank you so much for the time.
Of course. And to our listeners, thank you always for listening. I hope today's episode helped you understand some of those key decisions that you're going to make or be faced with throughout a purchase, especially as a first home buyer. So it's not always easy to make those choices, but it's all about that compromise. What are you willing to compromise on or not compromise on? And there's always 3 key points to that. It's your budget, the property type, and the location that you want it in. So those are usually what you're playing with. So think through your decisions. And if you enjoyed this episode and enjoyed listening to Jacob, please drop us a comment or get in contact with Jacob. His details are on the screen and in the show notes below. So thanks again, Jacob. And we will see all of you here next time on the No BS Real Estate Podcast. I'm Jo Agresta. Bye for now. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodi AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodi.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodi AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodi.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.